Welcome back to Trading 360. Time now for the 360 round. Time to dive into the latest look at the housing market. We had some new home sales data out today. For that, I want to bring in our panel, Aaron Skies, founding partner, Skies Properties, and Francis Katzen, founder of the Katzen team at Douglas Elliman. Thank you both so much for joining us today. All right, we had some new home sales data out today showing that jump to the highest level in about a year and a half. Aaron, I'll start out with you. What stands out to you about that?
Yeah, so the market was so slow over the summer. So it's actually quite surprising data. And in terms of the number of developments and starts and completions, I think that's where we're seeing the red flags in this market, because we see that there's 6% fewer starts, 6% fewer completions, but those numbers could be revised anywhere from 13 to 16% up or down next month when we get the revisions in. So from what I've seen as boots on the ground selling in 3 different markets, Florida, New York, and New Jersey, it has been slow as molasses. And unfortunately, prices haven't really fallen. We saw the Fed funds rate pull back, but then mortgage rates actually jumped up. So that seemed almost counterproductive, but that's because there is so little demand. A lot of people are waiting until after the election to buy.
Francis, I want to ask you then, what do you make of not just today's data, but we have like mixed signals this week. New home sales today showing it jump to the highest level in about a year and a half. When you annualize it, it's 738,000 units, according to the Commerce Department. But then you had existing home sales data out yesterday, plunging to a level we have not seen since 1995. Are you surprised by either of these data points?
Yes and no. I mean, I think we're all sort of on the heels of an election. We're also dealing with an affordability issue compounded by the Fed basically dropping 50 basis points 3 weeks ago. However, I would say that while sales have dipped 3.5%, we're also sort of seeing a supply issue. We're up 1.5% against last month, but we're up on inventory 23% at the same time last year. But absorption is down 1%. So, and yet the uber ultra luxury high end is breaking ranks that we've never seen. So Miami and Florida are showcasing a 350% over the past 4 years for luxury property that's traded over 15 million and above.
And then, Aaron, I want to send it back to you. It seems like there's still headwinds for the housing market. It feels like there was a big sigh of relief when the Fed made that rate cut, the 50 basis point, because it was honestly more than expected in terms of the average. Now the indications are that we'll get more cuts through the balance of the year. What do you think is the biggest headwind or drag on the housing market right now from your point of view, Aaron?
So 2 things. One is millennials, younger people cannot scrape together the 20% they need. So it's almost like mortgage rates are a moot point, because in order to get a mortgage, you need to put 20% down. And right now, with inflation and all of the other pressures that young people, millennials, exennials, anyone basically entering the housing market for the first time that does not have equity built up in a prior purchase, they simply can't get that 20% together. Secondly, it's what we are building. And a mountain that I am willing to stand on is that we have built far too much multifamily. The consumer does not want multifamily. They do not want a condo. They do not want an apartment. They want a single family home. And in order to make up for the lack of housing units, developers basically said, we're going to shortcut this process and we're going to build these large buildings that, in my perspective, will sit vacant. And, people just want their own 4 walls and a roof.
Francis, are you seeing the same thing, that people just want single-family homes?
I'm not. I mean, I think that the rates have definitely spurred the entry market, who have the least to spend and the most to lose, and have been price gouged on rental by 45%. Right now, there are vehicles out there for people to get financing as an entry market buyer, where they're only putting 5 to 10% down. I think Chase was offering that because banks need to lend money. And I do think that if you're an investor, buying into these multifamilies are not making sense with these current rates that are offered, still not as competitive as they once were. But the entry market does want in. They want to own equity. They do need to own equity. And actually, 60% of the purchase power that we've been seeing on the northeastern side has been parents buying for children. But over the four regions of the United States, we've seen an increase in movement for that segment, 3.5%.
All right, and then, Aaron, I want to send it back to you for a thought on one of the points you mentioned earlier was that we're seeing some, kind of stagnant action recently, especially with the election days away, honestly. Do you think that we'll see more unlocking following the election?
I definitely think so. And I'm based here in Palm Beach, and we are really bracing for the market to explode post-election. And if you look at the historical data, you will see that after most elections, I believe it's after seven of the last 8 elections, we have seen the market pricing really drive upwards. So this is a great time. If you are a buyer, if you can afford to get that 20% down, or if you're a cash buyer, particularly, in order to make a deal, this is where there's opportunity in the market. And it is what many, many have been sitting on the sidelines to experience. Now, it's always hard to not move with the herd and to be an individual thinker. But I encourage those of you who have been thinking of buying to go out there and to bid 20, 30% lower. Put in those lowball offers now, because in 1 month, I don't think you'll be able to do it.
All right, we'll have to leave it there, ladies. Thank you so much. Aaron Skies Properties, Francis Katzen, founder of the Katzen team at Douglas Elliman. We're out of time today. Thank you for joining us.